Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. Boy, my voice is not ready today, is it? I haven't really been talking to anybody today. So it is 11 o'clock, May 13th. Hope you guys are having an awesome week so far. It's already Tuesday, which is one of my favorite days of the week. See, there's a couple people online. Thank you for the like. Sorry about my delay getting started. I do have everything working. I got my new splitter. It's working great. Mike's asking if I just woke up. No, I've been up for hours. I just just to have that voice because I'm alone at home. Crean's off at her job, and that's I sit at my computer and type away, but I don't usually talk to anybody. So hopefully you guys are doing well. Let's get into today's chat and look at that working fantastic with the new splitter. We've got SPX trading up 0.9%. I've got this Fibonacci retracement tool on from the highs to the lows, and just kind of wondering, what if we'll see some sort of correction at this point in time. SPX trading above its 200-day moving average right now. So this is when I start to think about, have we got into overbought territory? I understand that this was a big drawdown. I understand this is a big recovery. I don't like this kind of market action. But it does definitely make me wonder if we're going to see a little bit of a pullback down into a slightly lower range. But it's really hard to say. We could continue up. We're not yet at the highs of the year. NQ, obviously, the correlation very, very similar. For the last 2 days, trading above that 200-day moving average, which is this blue line. We've got a point of control still above at 21,560, and we're currently trading at 21,300. So don't know if we're going to run out of steam on these or not. The Russell is still quite a bit lower. So that Russell index, we're hitting the high that we saw in March. And are we going to stall out? Are we going to pull back? Rather large gap here over the weekend. Obviously the Chinese news, Trump tariffs, making a deal. So that is good, positive news. Just a reminder before we get too far into this, this is not financial advice in any way, shape, or form. I feel like I didn't say that this morning. So let's get into it, and we're just looking at what I'm doing and what we're looking at. I would love to know your the triple Q strategy. Mike is reminding us, remember that triple Q strategy we read on Seeking Alpha? It's time to play. So I don't have any triple Q. I do have some TNA though, and I don't know if the strategy would be the same. Let's just pull up the triple Q. So the idea is that when the SPX is over the 200-day moving average, holding the TQQQ outperforms the S&P 500, holding the S&P 500. So what we would have done is, if we watch it on the SPX, we would have exited the trade on March 7th when it closed below. Actually, which would have been the day that it closed below? This would have been closed above, opened below, but closed above. So it actually would have been on March 10th. We would have exited the triple Q. So let's look at the price of what the triple Qs would have been on March 10th. And then yesterday would have been the signal to get back in where we closed above the 200-day moving average on the SPX. So let's just take a look at that TQQQ. And my brain is not working. What was that date? We're going to look at March 10th and then May 12th. Hopefully you guys are doing well this week. The market's been, I feel like this is the range we want to be in. So March 10th, we would have exited the triple Qs when it was trading at 58.28. We would have sold those positions and sold somewhere in there around that $60 price. And then getting back in yesterday around the 65 level. So, it's an interesting strategy because the backtesting says that it functions for us and that it is an outsized return, but this would have actually been closing at $60 and then buying back at $65 based on the entry that I'm aware of, based on the article that we read. So are you doing it, Mike? I would love to know. What else are we looking at here? We've got the VIX level at 17.98, definitely dropped down towards that average. Are we going to get lower than this? We might. You know, this volatility has been a time where we want to sell premium as option sellers, and we want to, you know, work on getting that decay working for us. Now we're coming down to this level where if we get too far below it, it is not worth our while often to sell premium, and we might want to take more directional strategies. US oil is trading at 63.62. We did see it drop under the $60 level, but has bounced and rallied back up. Gold trading up 0.4% today, again in its uptrend. Point of control being down at that 2,900 level. So it's trading quite a bit above where I would like to be buying. You know, 200-day moving average down here around that 2,800 level. Silver up 0.93%. A bigger swing lately, but this movement hasn't been as big as gold. So although it is up and it's above the 200-day moving average, it's a much slower moving commodity just in general. What do we have? Apple recovering to 212, which is basically back to the earlier month highs. We saw this high on May 1st. Point of control being obviously much greater. This is the tariffs reduction is great news for Apple overall. We're also seeing a shoot up in AMD post earnings last week, which they beat, trading at 112. Arcade trading at 57. So that's been a nice big technology winner this week. So for those people that hold Arcade positions, you know, I haven't been selling covered calls in this area for the last little while. Now that we're up at this 57 level, I am going to consider getting back into some covered call selling, because I like to sell when I consider a stock high enough in the range that I might consider actually selling it off. That's when I expect to collect a little bit of premium and reduce my downside risk. So you can see I've got this channel marked on here. We traded outside of it, but we're trading right now near the midpoint. Definitely any positions, if we break above that 60 level, I will definitely be selling covered calls, but at this point, haven't sold any yet. And of course, my patrons get those alerts the minute that I do that. So if you're not on there, why can I not find my buttons today? If you're not on Patreon already, head over to patreon.com, sign up for just for free so you can get the emails out, and then that way you can stay in contact with me. Mike says, I was a little late getting in today, so I missed quite a bit, but it's a long dated strategy, better late than never. Awesome. Good for you. How do you size that? I mean, I wouldn't want to do that kind of position with a whole account. I have some quite heavy exposure to TNA, and which is the triple Russell, and the drawdowns are big when they occur. You know, I've been in this position for quite a while. It is a profitable position overall, with the shares sitting at $31, which is wild because that's actually lower than I purchased them over the last 2 years. I've been in the trade for about 500 days or so, and I purchased around $40 was my entry. So even though stock's trading at $31, I'm net positive on the trade, with a price reduction of 25%, and that's because these pay about 50% annually, playing the weekly covered calls on them. I wasn't able the last couple of weeks, so my patrons know it's been very, very light trading for me in this drawdown. You know, the calls are great when we're above, not so great when they're capping their profits, when I think we might be rallying back, which is what I thought we might do. Let's take a look at Amazon. If you guys have any specifics that you want to look at, please let me know, and we pull up those metrics and we will take a look. Amazon has been definitely trending in a channel to the upside, and we are, you know, in the upper bounds of that, above that 200-day moving average. Are we going to continue to see this? I would expect so. I would expect we'll see a rally in Amazon at least back up to the previous highs of what we saw in January. What else do we have? We've got Baidu, quite beaten up this stock, and there may be opportunity here, may not be. Hard to say. Earnings coming up on that very soon. Chewy's trading at $39.44. We've got that's been a nice run. Yeah, what else can we say about that? And then obviously the cryptocurrency, big news this week was Coinbase got added to the S&P 500. It's going to be added to the S&P 500. So the stock's up 20% today, massive rally there. Bitcoin in general has been up. So we've got companies like MicroStrategy, Mara, all trending up higher than their lows from earlier this year. Everything seems to be in a bullish trend, which always makes me think, am I looking at a pullback, looking at the point of control and saying, where do these stocks typically trade? And this will take a second to load here, but, is that point of control lower or higher? Are we moving off that 200-day moving average? Are we getting into a position, if we look at like this weighted MACD, are we getting in a position where we might see a potential drawdown in the stock? This could happen at any time. So it's when I start to kind of cycle into more neutral trades in general. I basically picked up, Mike's just saying, I basically picked up an amount of buying power I was comfortable with being used for a while. It's only a very small portion of my account. Yeah, that's kind of how I would treat those, because it's like, it's hard. Like, I don't mind holding SPY, QQQ for, in very large quantities relative to an account size. But when we're talking about leverage products, that movement is pretty extreme. So I don't know if that's the right thing to do. I would love to pull up some trade ideas. So if you guys have some stocks you want to look at, let's take a look. Tesla has been moving up, with just in general news against, Elon stepping back and a little bit away from Donald Trump. Is he going back to Tesla? Is he concentrating a little more effort there? We'll see. There was also some rumors that he might step down as CEO. We'll see if that comes to fruition. PayPal has had a nice rally, still under its 200-day moving average. What else do we have in here? Walmart, trading in its typical range. Walmart has been a great stock to hold over the last couple of years. Just continuing to create profits for investors. So if we're looking at those long-term stocks, a lot of them are here on this list. TDT, Trade Desk, TTD. We saw quite a rally here after earnings. So we had an earnings beat, a gap up, and quite a good momentum at this point in time. Will we continue to see this? I would expect that we'll see the stock back over $100 again. So I would be leaning a little bit long after that earnings beat, and knowing that this was a huge gap. So there was very light trading in here. If we get over that $80 level, are we going to just zip right up? We could. This is the type of thing where if it gets enough momentum behind it, it can just rally very quickly. So watch that. Jim Tidmore picked up some more SoFi today. Good for you, Jim. It's trading at 14.23. This is, one of these stocks we talked in the last session about just how much option premium there is. Let's take a look at SoFi on the list and see how much premium we can get on a monthly basis. If we're going to go out to, I'm going to go out to June, which is 38 days away, looking at a typical position for most investment accounts. If we were to buy something like SoFi and pay $1,423 for 100 shares. Now, most advisors are going to tell us that a good annualized return is somewhere in the 7 to 10%. If we're talking to a bank, they're going to tell us a good return is like 5 to 7% per year. If I'm looking at a position like this and I have 1424 is my risk, and I want to sell a covered call against that, I am able to collect 60 cents for the June 20th, which is only 38 days away. From a percentage standpoint, this is massive. I'm just going to click on the advanced button here, add the stock leg, and what we'll do is we'll look at that profit profile, and we can see. Drag this around here to get this on there for you. Come on. I don't know why it's doing that. It's on one of my other screens. Help very much, does it? Okay, let me try something else here. I'm just going to do a little screen grab and pop that up here for you. Sorry about that. So there's SoFi. I was trying to get it on the screen here, but probability of profit is 61%. Now that's some profit. That means that the stock has to trade above the break even. On this case, the break even is going to be $13.69. The reason for that is because I'm purchasing the shares and paying $1,425 for them today. You can see that price down here. And we're also selling the call and agreeing to sell the shares at $15. So this is a classic like buy right position where we are buying, buying the stock for 100 shares at $14.25 and then selling that covered call. The max return is $130. Now, from a percentage standpoint, this is massive. Let's just say that SoFi went up above $15, and I'm not saying that it's going to. Let's just say that it did. What kind of return are we getting on that? And the reality is we're making $130 on a risk, an out-of-pocket expense of $1,366. Well, $1,366 that's a 9.5% return in 38 days. So it is a massive potential. Now that's if the stock trades above 15. We can alter this. We can actually sell these in the money if we want, so we can reduce our risk even further. If we do something like that, the amount of capital out of pocket gets reduced to $13.20 instead of $13.69. We have a much smaller max profit. The max profit now is only going to be a return of $1,400, which means we're about $80 profit. And if we did $80 divided by the $13.20 that it would cost, we're getting a return in a month of 6%. This is massive. This is a huge amount of money. Now, again, we can't go all in on these. This is the type of position where I might hold at the very most 2% of my net liquidity in a stock like SoFi. And of course, we can do this buy right position. We could start it similarly to the wheel, where we say instead of buying the stock for the current price and selling the call against it, we could just do this as a short put. So if we clear these off, selling that 14 short put gives us the exact same profit profile. Let's see if I can get that to move over here. Oh, it really doesn't want to jump onto this screen. Doesn't matter what I do here. No, doesn't want to go. But it gives us that same profit profile, which is, flat top with the max profit if SoFi trades above that $14. And let's see where we go. We got here. I was just trying to pull this up, but that's what it looks like. We've got $74 profit, 69% probability of profit, max loss $13.20. And again, if it stays above $14, it's a 6% return. Selling that 15 gives us more potential, but also a little more risk because the break even is lower at $13.69 relative to $13.26. So when we're looking at the chart and we're paying attention to that, there is a big difference between $13.69. So this would be the 15 buy right and $13.29, which is here. And we can see that both of those trades are bullish and expect that maybe the stock might go up, but they have a relatively large return that happens on a monthly basis. So they can be quite lucrative little stocks to play. Obviously, the best time to buy is when we talked about it a couple weeks ago when we were, looking at that $9 range. That was the time to be entering when it was trading below the 200-day moving average and not above it. So I like to play with a little bit more safety, and I would probably be selling that 14 call against my long shares rather than assuming that it's going to go up above 15. But either one is pretty good. Lori, Palantir's at all-time highs. You know what, Lori, I'm glad you brought that up. Let me just pull up, this is Investing Pro. I'm going to just show you the calculated value for fair value for Palantir. This is not my numbers. This is investingpro.com. So this is a subscription service. I have a discount link if you guys are interested in that. You can check out the description below, and you've got all my links for all my discounts that I offer to viewers. The fair value right now is $56. Stock's trading at 129. The downside is, close to 50. Well, it's 56% down. Uncertainty is high. So we just have to be aware of these things. Like there's lots of bullish stuff going on. Net income's expected to grow. Analysts anticipate sales growth, and they've revised their earnings upwards for the upcoming period. So analysts target are anywhere between $18 and $150, and it is So with Palantir, I'm looking at that saying, play with caution, because I don't want to see anybody get burned on a stock that, was trading at $8 last year or 2 years ago. And if we look at the 1 year chart, I mean, it wasn't that long ago. This was a $20 stock. And although it's trading at 129 right now, usually this is the time where we're looking at something that if there is going to be a crash, it could happen relatively rapidly, and it could go down quite a bit. Now that $56 range is actually like 6 month prices from 6 months ago. 6 months ago. Would I consider wheeling SoFi or jumpy? Yeah, I think SoFi is a great one for the wheel, because it does jump around enough, but the premium is fantastic and it's so small. So I definitely don't think that it's great to just buy a bunch and then sell covered calls. I think it's smart to really look at SoFi from a perspective of when is it going below and above its typical averages, and the premium is so big in it always that if we watch this 200-day moving average line, it's really great opportunities when we're trading at it. And right now, I would definitely be on the conservative side, just from where it is. But great little company and trading relatively close to its fair market value. So if we do this, like if we compare this to something like Palantir, where did SoFi go here? Fair value is 967. So still definitely has some uncertainty in there. That's 32% lower than its current price. So this is why I don't like to go all in, and why I would play the more conservative route on these. But again, we've got lots of analysts saying we're bullish. We're trading at a relatively low price to earnings ratio, and then obviously a significant return over the last week. One of the bad things is that it's trading at a high earnings multiple. So those are the kind of bear bull cases. And then we've got earnings coming up. Well, not till August, because the last one just came out a week ago, and it was a beat. I'm pretty sure the SoFi beat on earnings. Yeah, it was. So we can see that here on TradingView. We saw a green earnings, and so it beat earnings the last 4 quarters. Nice little company, but mostly it's just we're chasing those nice dividends. Sorry, not dividends. The premium from trading covered calls and short puts against it. ARK is another one. Like I think that for people that are looking for tech diversity, the Qs are such a big product. I traded QQQM, which should be on here. It's not. So QQQs, for somebody to try to wheel the Qs, you're looking at $100,000 position for 200 shares. As soon as we get into QQQM, we've got that price is, let's go. Let's pull this up here. Price $212. So now we've got a $42,000 position to wheel QQQM. They're very, very similar. Their management fee is similar, and they're both tracking the same underlying, the Invesco 100 or the NASDAQ 100 shares. So we've got 212 compared to 516. I prefer to play QQQM at that 212 level. And the last time I sold covered calls, I sold them at the 220 level. So we're getting right back up to that. And it will be very nice. I'll be selling those again. And these are just like long-term holds, using the premium to add to my position. And it's nice when they're a little bit cheaper. when we look at something, let's just compare like the monthly return on the on Qs rather, or QQQM relative to ARK-K, and then we'll just take a look. So let's say we went to the 30 delta out of the money call, covered call. We sell that for, the strike is 220 and the collection right now is 240. So quick math, we're getting just slightly more than 1% in 38 days. So it's right around that 1% monthly. So if we were to take our calculator out again, we would be able to see that $240 collected divided by an investment value that is currently $21,260, so 21,260, and that is 1.1%. We divide that by 38 days, and then we times that by 365. This will give us an annualized simple return. So selling that 30 delta gives us an 11%, a 10.8% return on risk capital. That's an okay adjustment. So that means that if I did that every month, if I sold the 30 delta put and the stock went down repeatedly every month, then I would at least make 11% of my capital back in covered call income. And so that kind of it helps the return. It also gives us upside potential each month. So this maximum return would be, not only the $240 I collect, but also the potential increase from 212 to 220, which is another $750. So in the month, I could actually make about 3% monthly. If I did this, if it went up every single month, that's about a 36% return annually. Pretty awesome. Now let's look at ARK-K and just compare. Now, obviously, ARK-K is slightly cheaper. We've got that 57 strike right now, or $57 price basis right now, and that's how much it would cost us to get in. We'll go out to the same date, June 20th. We'll look at that same 30 delta position, and you'll notice right off the hop that this premium is huge comparatively. We got $61 of strike, and that is returning a $1.30. So we're making about 2% return. And we'll run that math just so we can confirm. But if we were to sell that 61, we would get $1.33, $133, and divide that by the total cost to enter, which would be $57.35. $57.35, and we're going to say 2.3%, divide that by that 38 days and multiply it by 365. We're going to be at that right around 24%, 22.2% annualized for that return on capital. This means that the selling covered calls against ARK-K provides us considerable safety net comparatively to QQQ. Now, is there more volatility in it? There quite possibly. This is a hand-selected fund. Kathy Wood selects this, but that extra premium can be worthwhile. So it depends on what we're looking at. Now, if we look from a drawdown perspective, we went from a high of 67 to a low of 37. So that's a $30 move on a $67 stock. So $30 divided by 67, we're looking at a drawdown of 45%. And we did not see that in the Qs. It is something to take into consideration. But ARK-K, because the premiums are so massive, it's a nice little position, to relatively small, just being in that price point where it's only a $5,700 position for 100 shares. So you can wheel it for under $12,000. And it is a diversified ETF, and there is no earnings on it. So those are all pros for ARK-K. So when we're looking for tech exposure, we've got individual stocks like SoFi, we've got ETFs like ARK-K, QQQM, and then QQQ. And then obviously, if we want to, we can go into what Mike was talking about earlier, where we have a little bit of leverage in that the triple Qs, the TQQQ, which is a bullish strategy. Now, the idea behind that, Cole's notes on that particular strategy, is that in general, when the SPX is above 200 a day, above its 200-day moving average, the triple Qs is more likely going to have more up days than down days when it's above that average. So over time, that should outperform. Just buying in the triple Qs and holding it until it drops again below that 200-day moving average on the SPX. That's the theory. It has backtested for a very long time and outperformed the S&P 500 returns. Jim says, I did start the wheel on SoFi last week. I'm assuming that's what you did. That's awesome, Jim. Jackson says, I always seem to join when you're having issues with IBKR. I swear it's me. No, it's just clumsy. It's like a clumsy platform. It's actually working pretty well today. The data's loading and everything's working, which is nice. Jim says, I did sell 2 sets of 3 puts for 12 June 6th, still going up. Also did sell 1 sell of 3 calls for 15, same time frame. Yeah, so I mean, that's exactly what the wheel is. You know, I tend to be a little bit like, I don't love the wheel. It's not my favorite strategy because when it does go down, boy, does it hurt. You know, like I was hurting on my TNA positions earlier this year. And with this drawdown, and similarly to RK, where you have like the stock just dropping such a huge amount when we're using leverage positions, or when we're in an individual underlying and it just goes down. Like if Palantir right now is just trading at 129, if it was to go back to $25, there would be so many people hurting right now, and I don't like to see that. So if I was playing Palantir, I would definitely be playing with spreads. That's the only way that I would play it. I would be looking at setting up butterflies and things that let's just take a look at it. Well, things that limit my potential loss and still allow me to make some money if I'm right, and if I think the Palantir is going to stay up. But when we're looking out at a position, and say we go out 20 days and we're looking to collect 1%, the delta on this is only 7, so there's a 7.5% chance that it's going to be trading below 97. What can we do with that spread? Say we did a 7 wide. Is this worthwhile to trade this type of thing? Well, if we look at the bull put spread that I'm pulling up here, I'm just going to move it, and then I'm going to move it, and then sorry, I just have to do a screen grab of this for you guys so we can look at it. Here's the bull put spread. It's got a 94% probability of profit. Max return $40, max loss $706. Now that is not a great risk to reward, but it also has a limited loss risk. If the stock was to go down to $50 a share, I would rather be in a position like this where I'm only out $700 than be in a position where I'm chasing some short put on a stock that is trading at $20 that was 129 when I entered it. It's really hard to recover from those large losses. So I think it's well worthwhile to play those positions, and we can build them out in different ways too. So, you could always go out and build some sort of strategy that might work for you. Let me just pull up like a diagonal on Palantir. If somebody was looking to play it, looking out this 10 days, say I wanted to have a slightly bullish position, pretty easy for me to go out. Let me turn these off. So I'm looking at doing selling a 10-day put and then going out and buying a put. Now this is going to give me a profit profile that allows me, let me zoom in here. I know you guys can't see it yet. I'll pull it up here in a second. So I'm going to just get it sorted so I can't adjust it on the fly. But here we go. There is the type of trade that I might want to take and say, okay, this trade makes money as long as Palantir stays, under 137 and above 120. And it's got a limited amount of risk on it. I am making positive theta decay, and I can take this trade. And if we stay inside of it, you'll see the theta decay is $15 a day. So this dotted line will grow over time over the course of the next 10 days. It has a very large potential. The risk to reward is huge. You know, you could make up to almost 100% return. If there's a volatility spike, if the Palantir drops, the IV increases, there could be even more potential in it. So these are the types of trades that I would be considering taking on Palantir, something like that, and really trying to pinpoint and say, where do I think it might trade based on the chart? So if I'm looking at the chart now and saying, let me just close this for us here. You know, I think that stock might trade at that 127 level. But I also think it may stay in a range over the next 10 days, which is what the blue cone is expecting. Those types of trades can have a very decent return. Now that bull put spread that I showed you before was 30 days out and it had a much wider range. You know, it had no profit. It had no upside risk, and then the downside risk was that it dropped under the 97 level. So you know, there's different types of risk to reward, and Palantir has enough velocity in it potentially that I don't want to be holding a position that has too much risk on. So that's kind of how I'm playing it. If it comes down, like if we're back at that 80 level, then maybe I might consider it again, but not when it's at 129. And in all likelihood, it is going to continue upwards. So it might be smarter to just buy some calls on it and hold them and see if it just surges up. Like buying calls yesterday would have been a fantastic play today. They would have already made money. Mike Mueller says, I'm very excited about my round hill positions with this run up. I've been dripping every week on red days since January. Good for you, Mike. I'm pretty excited about my round hill positions as well. I have not been doing as much dripping as you have. I haven't done it every week, but I definitely have been adding to it using some of my limited covered calls over the last little while. That income has been flowing into my round hill products. So we'll see what happens, but that YBTC is still one of my favorite positions right now. It's trading at like almost $36 today. I don't even have it on the list here on, let's look at, boy, block has recovered a lot. Hey, that's that XYZ that I just typed in there. But YBTC, for people that are looking for Bitcoin exposure, these are pretty wild. The dividend payout on them is massive. I said $35 to $45. I started buying this. I made some videos on this earlier this year, but I started buying in January and around that $50 level. And the dividends are massive. So when we look at it from the perspective of how much money are we getting back, especially in a registered account like in Canada, if holding this in an RSP, when we have something like YBTC, the dividend yield right now is a whopping 61%, and the dividend rate is 27%. So it's huge money just being paid out in this. If we look at the dividends, the 25 cents, 44 cents, 30 cents, 28 cents, 32 cents. And this is pays every week. So May 7th was the last one, only 25 cents, but then you can see that we had the run up in the price as well. So quite a fantastic potential in a product like this. And all the Roundhill products are quite nice that way. I'm holding some XDTE, RDTE, and QDTE, but all of them are very similar. So this is the Russell 2000 0DTE covered call strategy ETF, and basically on a weekly basis, paying 23 cents, 25 cents, 31 cents, 23 cents on a stock that is $34. So when you look at that from the perspective of how much money does it make, if we were to make, let's just say we made 25 cents. Clear this off. 25 cents times 52. So $13. Now this is a $35 position. So that yield right now is 37%. Where that's a high yield. You know. Now the dividend yield here is uncalculated on Investing Pro, but this is what we're looking at. Like the price history over the last year, up 3.82%. So buying 1 year ago today, holding for the year 3.82%, but then also collecting a 37% dividend. So that's a 40% return on capital in a single year. These are relatively new products, and I like them because of that. So thanks for bringing that up, Mike. I appreciate it. What other stocks do you guys want me to pull up? I've got Seeking Alpha and investingpro.com open so we can take a look at those. John Blake says, happy Tuesday. Happy Tuesday, John. You missed the beginning when I had no voice. No, I'm joking. It was barely bad. I should have had a cup of tea before I started. Mike says, for people watching and curious, it literally means holding TQQ shares, not options. Yes, thank you for that clarification. For the triple Q strategy, it is a very simple strategy. Purchasing the shares and holding them. So purchasing them when the SPX is above the 200-day moving average, and just holding the shares up and down until the SPX drops below that 200-day moving average. That's the strategy. It's very, very simple. Back tested, has quite a nice outperformance. Again, I probably wouldn't be going whole hog on it, but it's pretty nice. Jim says, SoFi was my very first live options trade. Looking forward to learning better strategies. Good for you, Jim. That's awesome. SoFi is, it can move quite a bit. So I definitely think that, you have to size those things appropriately. When I'm looking at something like that, if I'm looking at SoFi and I know that it's $1,400 and I want to trade 200 shares, say I want to do the wheel on it, I know that I'm going to allocate only about $3,000 to that. So that's sizing for about a $75,000 account is 200 shares of SoFi. Just to keep in perspective of like how big, when we're talking about sizing, having long shares in an account, which is what the wheel is, are actually relatively large positions, and we don't want to get too loaded up. Even though the returns can be quite good, we don't want to load up on those because, we can load up by purchasing other shares that are similar, SoFi being one of the good ones. Maninder, I haven't seen you around before. NVIDIA trade for earnings. Sure, let's take a look at NVIDIA. We'll look at the expected move. And so we've got, let me share that with you. We've got NVIDIA trading at 129. I don't love earnings moves or earnings plays, just so you know. It's like when are the earnings here? I was expecting bigger premium in there. Next earnings, May 28th. So we're too far out to be putting on earnings trades because the earnings aren't until May 28th. So when I looked at this chain and I looked at the 3 days to May 16th, and apologies for not being right on top of when the earnings date was, but I immediately knew that something was amiss here because we've got $125 put. It's trading for only 54 cents. Now, if we go out to the earnings date, if we go out to the earnings date that is post the earnings, which we're expecting here, what did we say? May 28th, right? Next earnings, May 28th. So if we go to May 30th and we look at the implied volatility, now what are you doing to me? Let's look somewhere else here. Okay, there we go. When we look at that 125 put, you can see how much premium there is. It's $410. Now, I don't play earnings this far out. This is generally when, if I was going to do earnings, it would be within a couple of days, probably the day before or the day of earnings if it's an afternoon release. So before that, what can you do? You could play for the IV expansion that's likely going to happen. So you could like sell a 125 put and then go out to June 20th and buy the 125 put. And what that could do, this could actually increase in value over the course of time leading up to earnings. Now, it's a little bit tricky, and you have to be a pretty experienced options trader to understand how these types of moves are going to happen. I'll pull up the chart. This is what it looks like. If this was to be held over earnings, the profit profile would not be nearly this big. Now, that being said, it does have quite a bit of potential. It just doesn't have as much potential as it shows. This trade, to put this in, would be $1.35 or $1.50 depending for debit. So you've got a max risk of 150. You know, you do have quite a bit of potential. But if, say, the stock gaps up to 140 after earnings and is trading well above, then there's not going to be any premium in that June 20th 125 put that you're holding for the the 125 strike. The May 30th strike will expire worthless because the stock would be trading at 140, and then there just wouldn't be very much premium in here. So to do these types of trades, what you have to do is find ones that are extremely cheap, and then when you get that, now there's greater potential. Or you play them for the IV expansion, which may occur, and you just look for a small gain. So get into this for $1.50, hope that there's like a little bit of a pullback one day closer to that 125. The IV expands slightly, and maybe take this out for, you know, a 10 cent or 15 cent return, which is, you know, basically between 5 and 15% return on risked capital. So that may be one way to do it. The other thing we could do is just look at doing a much tighter one. So do like the May 30th and then June 6th, and see if we can get into this for a much cheaper debit, and showing that those puts are it's still around them. I feel like that doesn't look right. It should actually be cheaper. See if this data loads here. I don't know why it's always so slow. So yeah, so now this is much cheaper, and when we look at the profit profile in this, again, you won't have as big a potential, especially if we were to hold these over earnings. But the lost it. Screen grabbed it and then lost it. Give me one more second. I'll pull it up. This one, you know, 50 cents and to enter, so you got $50 risk, and then much smaller potential. And again, this potential not nearly as big being held over earnings, because even if we did hold it and there was, say it's May 30th, this put expires worthless, the June 6th put 125, what is it going to be worth? Well, look at what they're worth prior to earnings. If we close this and we go and look at what's expiring this week, the 125 put's worth 54 cents. So you'd be lucky to make your money back selling that for 54 cents if you bought it for 54 cents. It would be a break-even trade if the stock was trading at 129, if that makes sense. Mike says, did you see the video John Salaman said with Simon Black? He places a broken wing butter on the upside and a diagonal on the downside, 6-legged strat that's pretty intriguing. Felt like it's something right up my alley. Already took them, Mike. So I'm on my second one already, looking for a little bit of a pullback. Simon, pretty interesting little trade. I don't love that it's like put on the Friday, taken off on the Thursday prior, but from a metric standpoint, it works pretty well. My first trade was, I didn't enter on a Thursday, I entered it on a Friday. I had to take it off before the weekend, and it was a small loser, but quite small. Unfortunately, IBKR won't let me put the trade on. If you guys want to see what it looks like, it's a really fun little trade, actually. In the demo that Simon and John did, they were looking at SPX, but it is designed to be played on the Russell. So what we would do is we would go out. So typically it's entered on Thursday, and looking for an 8-day trade. So today, we could do it for today. It's Tuesday today, so we would do the first expiration. Just trying to do a little math here. If we do the first expiration would be May 21st. So 8 days out. And then load this up. And basically it's a diagonal 3% below the current price. So if we if we take a look, if you guys haven't seen the video, I'll just run through what the parameters are. So today Russell's trading at 2105. We times that by 0.97 to give us a 3%. The strike that is 3% lower than the current price, which is 2041. It's actually pretty far out there, surprisingly. And then the idea is that you would go out to a later expiration that is 4 days away. Could we do it on this? Doesn't quite set up very well this way, but basically you're paying around $2 for that little diagonal, and that in itself is a nice trade. And thanks, Mike, for bringing this up. It is very much up my alley. So this was a trade immediately when I saw the video. As I said to Karine, well, this is exciting. I should also show you this modified dynamic hedge that I put on this week. It's wild. But let's look at this Russell peak. So you've got, if there's a pullback, we are immediately going up into a profitable zone. The max loss on this side of the trade is $250. The strikes are the same, and they're about a week apart. So the max risk you've got is slightly more. This is dependent on the IV expansion. So there's slightly more risk to the downside. That's the diagonal portion of it. And then on the top side, we do the same thing with a butterfly. So we'll close this down. And on the May 21st expiration, we would go 3% above. So get out our calculator again. And this time we're going to be 2105 times 1.03 is going to give us our center, which is 2170. So that's around that 16 delta. And then it's building out a broken wing butterfly. So, and we have to have enough risk on. So there's like the 10 by 15 kind of works. And we'll sell 2 at the center. Unfortunately, I can build it here in IBKR. I can't actually execute this trade. So you've got a debit to put it on of about, just under $200. And the idea with this is that you end up with a position that is a butterfly. And I like this setup. I like everything about this setup. When Simon was explaining it, I'm like, okay, so fantastic. You've got a short delta position. So overall, it's short delta just barely by 0.03. It's got positive theta. And we know that if the market does retrace, that diagonal benefits from the IV expansion. It's a relatively low risk trade. I mean, it's $820, has the potential of making it up to $750 or $1250. Doesn't get held to expiration. It always gets closed the day before. So if we were to look at what the price of it is the day before, you'll see what the profit tent looks like. I'll pull it up here. And the one we're looking at right now, the dotted line is today. And I'm going to pull up what the dotted line looks like on the day before expiration, which is the 20th. And you can see that it's a nice little profit of $250. The idea that Simon does is he looks for a 10% return on the risk capital. So in this case, the max loss on the trade is around $820. So we'd be looking for a profit to close the whole trade of about $82 after commission. So you kind of have to factor that in. The unfortunate thing for me is that IBKR won't actually I can chart this trade. I can't actually put it in. So then it makes it difficult to have that 10% exit strategy applied as part of the profit taker, which is a tiny bit unfortunate. But overall, I can build the strategy, visualize it, and figure out where my break-evens and stuff are and take a look at it. And I like it overall. I think it's great. I said about a dynamic hedge. Let me just quickly look. BITO pays a good monthly dividend. Yes, BITO is also another one that is a decent. The BITO is a slightly different product. It is Bitcoin exposure, but when you have, so let's just pull it up here. It's the Pro shares, and does it talk about how these work? So on the 1 year, we've 54% return on Bitcoin, and then the dividend yield is currently 30%. So you're looking about an 80% return. So now if we compare that to the YBTC, which generates its money from selling covered calls on a daily basis. So the 1 year return is 41% and the yield's currently 61. So we're looking at about 100% return on capital. So similar underlying, slightly different setup. What I like about these covered call strategies is that they're just holding those for 24 hours. It's a bit different on the Bitcoin one. I actually don't know. I didn't look into the research as to when the options are being entered and exited. On the other products that Roundhill offers on like RDTE, QDTE, and XDTE, those covered calls are only in play during the 6.5 hour market day, which is extremely awesome because on a gap up that we saw, like if we look at RDTE, over the weekend, we saw the Russell jump up. And if we look at the 1 week chart here from May 9th, when it was trading at $33, to the 12th, it went to $33.98. We saw like a dollar move in that session. And that's partially due to the fact that there's no covered call being held over the weekend. It is taken off before market close and then put on market open, which is pretty great. I love that. I think that there's more exposure, and because one of the problems with covered calls is that it caps our profit. So eliminating the amount of time eliminates that overall risk that we're gonna miss out on a gap, if that makes sense. Starbucks, let's take a look at Starbucks and find one here that maybe is trading under or over its fair value. So fair value is at $85, so rate 1.8%. When I'm looking at something like this is where I would play like a neutral trade, and I would say, okay, where has Starbucks been trading down? But when it was trading at 115, we knew that this fair value, which Investing Pro doesn't have a fair value, it doesn't have a back tester on it. Like we can't go back and see what it was at that time. But I would venture to guess that if we had looked at Starbucks in February, it would have shown that the fair value is around that $85 mark. And then this is where the stock has come back down to that value. So it's an interesting way to use these paid services, especially Investing Pro. That fair value is something that I've been leaning on quite a bit and just saying, where could this go based on the current metrics? May 28th, thank you so much, Lori. I'm slow at reading my messages, but that was for the earnings of NVIDIA. And then Jim's asking, how does ECC look for, let's look at ECC. Eagle Point Credit Company. Assuming it's going to be a dividend payer. Ex-dividend date June 10th, dividend amount 22% yield, annualized payout. Payout ratio is not good. If you're paying out more than the value of the money that you have, that's not such a good thing. I would venture to guess that this dividend rating has a not very good rating on Seeking Alpha. Payout ratio on according to Seeking Alpha is 152%. Doesn't have a warning on here. Interesting. I want to look at just the price here. Trend is the wrong way. That's for sure. So from $15 in 2021 to $8. So we've seen a 50% reduction in capital, and 22%, and the dividend is 29%, 23%. Yeah, this is one of the issues with dividend paying stocks. Like you get this setup and it's like, so what? You're losing as much as it's paying. This is a hard thing, and this is where I've kind of shifted gears over the last couple of years and said, why would I be chasing something that has a 23% yield if the 1 year return has been negative 22%? That's like a non-return. I could have made way more money just holding something that had some upside trend rather than downward trend. So I'm going to pass on a company like this. The main factors being this payout ratio being 152% and 191% from a calculated value. And the stock has lost just as much as the yield. So I would say that that's likely what's going to continue to happen with a stock like that. Balasong says, if you want millions, just invest in Telomore Pharmaceuticals. Tello, they cured cancer, but it doesn't have any attention on it right now. You know, let's look at this. I love these kind of things. Telomere Pharmaceuticals. Pharmaceutical companies, of course, you know, like are one of those things that they can go belly up completely. So anytime we're playing with anything that has the word pharmaceuticals in it, basically that's like play money. We have to pretend that we're going to just lose all of it. So not profitable, operates with a moderate level of debt. Analysts do not anticipate the company will be profitable this year, and then suffers from weak gross profit margins. And pharmaceuticals like this, I know about people that work in the financial sector portion for companies like this, where they're preclinical stage biopharmaceutical. They're developing products, and what they have to do is they have to continually get money from people. So it's always great to look at them and to say, okay, how can we? Is there an opportunity here? But typically, if they don't get funding, the company's just gone. So I don't know specifically about this particular company. You know, looking back, it looks like it's been around for a while. Was an $8 stock in 2024. Yeah, so it hasn't been around a while at all. Like this is a year old, and from $8 to $250. From 9 to 250. So 60% of its capital gone. The trend is to the downside. Now, of course, they could have a brilliant product and they still may not pay out shareholders. Are there opportunities with options? Could be. So let's take a look. It's 12:06 already. I can't believe how quickly it goes. But if you guys want to stick around, I will continue to trade these telomere pharmaceuticals. And Balasong says they haven't released drug publicly yet, but studies show it reverse aging, curing cancer. I like I said, they could have an amazing product. It just, who knows? Pharmacies are just one of those. Unfortunately, they're one of those. No companies. I don't know what it's showing it, but then it's not showing it. You know how that goes. I'm gonna pull the plug on this just because of the time. But I appreciate the insight. I will take a look at it, and if I find anything interesting, I'll post it in one of my shorts this week. You guys are fantastic. I appreciate all of you joining me. So it is fantastic that you're here and that you're expanding your knowledge and thinking about finances in a slightly different way. Let's get rich together. See you on Thursday. Take care. Bye.